Here's an introduction to our chapter number 5. The title is Itemized Deductions versus the standard deduction that we had learned in previous chapters and have been using in past tax returns we've been preparing. In future videos for Chapter 5, we'll take a look at specific types of itemized deductions. For example, one for health-related deductions, another for taxes we pay, another for mortgage interest, and then charitable contributions. We won't have a separate video for casualty and theft losses since it's very limited for individuals. And this last topic here in this table of contents really doesn't apply. Here it says reduction for itemized deductions for high income taxpayers. This rule has been eliminated for the past few years and may come back after 2025. So we'll skip that topic. Let's take a look at the 1040 form and kind of review the so-called tax formula. So if you remember in past chapters, we've been totaling up our different types of income we're learning, chapter 3 and chapter 4. Then we subtract out deductions called adjustments we learned in chapter 4 to get to the adjusted gross income. And so far this semester, we've been subtracting the standard deduction from that adjusted gross income. So the main amounts of standard deductions you can see off here in the margin. And they're relatively high compared to previous years. They had a big jump back in, I believe, 2018. And there was additional standard deductions in the case of people age 65 or older or blind. And there was a special calculation for dependents standard deduction. But now here in chapter 5, we're going to possibly deduct itemized deductions. If you see the or here, that means you're going to deduct either the standard or the itemized and not both. And of course, we want to deduct the larger of the two to make our taxable income smaller, and thus we pay less taxes. So for most taxpayers, because the standard deduction is very large, very few taxpayers now claim itemized deductions that we're studying here in this chapter. Let's take a look at, before we take a look at itemized deductions on Schedule A, let's take a look at the Hawaii tax form. So individuals will file this form N11, and just like on the federal return, we claim either standard deduction or itemized deductions. Here's the amount of Hawaii standard deduction. So in the case of 103, that's single or married filing separate. Take a look how small the amount is. $10,000 smaller than the federal amount. Or in the case of married filing joint or qualifying widow, it's $20,000 smaller than on the federal. And here's the head of household amount. So it is common to claim the standard deduction back on the 1040 form, but when you prepare the Hawaii return, possibly you want to claim itemized deductions. Okay, that's perfectly legal to have different deductions, standard on federal and itemized on Hawaii. Also, before we take a look at the Schedule A, if you file separate returns from your spouse and one of the spouses claims itemized deductions, itemized, yeah, and not the standard. That means now both spouses, both separate returns have to claim itemized deductions even though they may be less than the standard. Okay, so when you file separate returns, you're committing not just yourself, but your spouse's separate return to be either standard or itemized. Again, if one spouse claims itemized, both have to. Okay, let's take a look at the Schedule A. This is where you report your itemized deductions, the names of the taxpayers here at the top, and the social security number of just the first spouse if it's a joint return here, and the different categories. Again, we'll have separate videos, yeah, for each category. So for medical, for taxes that we pay during the year, we'll notice if you pay federal tax, you don't deduct it here, yeah, it's other taxes. And possibly the mortgage interest you pay, and then charitable contributions. Casualty and theft losses probably will not apply for most taxpayers. The general rule is that it has to be from a casualty for a federally declared disaster area, typically like a hurricane or those big wildfires in California right now. Yeah, or flooding. And again, it has to be declared as a disaster by the president to be able now to deduct something over here. And that loss is after any insurance proceeds. And you also have to reduce it possibly by 10% of the taxpayer's adjusted gross income. So for most people, even if they have a disaster, it may not be deductible. We'll learn about these other itemized deductions in Chapter 6. Very few of them, but we'll spend just a little bit time on that in the next chapter. Then we total up all the categories here of itemized deductions and claim it back on the 1040 form. It used to be that this amount here had to be reduced for high income taxpayers, but again, that's not going to be in effect or not going to be applied until maybe after 2025. Okay, so back here in the 1040 form, again, here's where you would report your itemized deductions, line number 9. Okay, take a look at the next video that talks about medical itemized deductions.